And welcome back to the Business Career College video series. In this video, we're going to have just a short lesson here on joint ownership and taxation. I don't know how common this is in real life. I know that people do buy properties together and we get some messiness like this. And I, by the way, am no big fan of joint ownership in general. I think it works between spouses. But other than that, it's a difficult scenario. I did do another video on this. I did a video on the Kalmusky case where I touched on joint ownership and presumption of advancement. We're just going to focus on taxes here. So notwithstanding that I don't think this is a great idea, in this case, Alan and Bert buy a property together. And my other comment on this is I believe one of the reasons I get this question so often is because there's a practice question on one of the FP Canada CFP practice exams that has a similar kind of layout to it. And I think that has people concerned about it. I am concerned when people study because they see that content on the practice exam. I don't think that's a great indicator of what's going to be on your actual exam. But at the same time, I understand that being confused about a concept probably renders you unable to learn other concepts. So it's important to learn this, I think, so that you can move past it, not so much so that you'll have this down for the day you sit down to write the exam. Okay, so of course, Alan and Bert are going to buy this beautiful Zoom house. It's a gorgeous house, and it has a fair market value at the time they purchase it of $400,000. And they're going to both buy it with a 50% interest. So brother Alan here owns 50% and Bert owns 50%. And they both put $200,000 in to buy it. So what they've really done here from a tax perspective is that Alan now owns property. He owns a 50% interest in this property. He's got a fair market value of $200,000 and an ACB of $200,000. And Bert has the same thing. Bert owns the other half of this property. So even though joint ownership doesn't quite work like this, from a tax perspective, this is what happens, is that brother A has fair market value of 200,000, ACB of 200,000. Brother B has fair market value 200,000, ACB of 200,000. That's easy enough. Now, let's say that we fast forward, I don't know, I won't make any jokes here about the real estate market, maybe more than a week. And that's where Bert unfortunately dies. Now, let's say we have joint ownership with right of survivorship. And, oh, sorry, I apologize. We have a joint tenancy here, or tenancy in common. And when Bert dies, then at that point, at the moment of Bert's death, the property has a fair market value of, let's say, $600,000. It's increased in value by $200,000. That means Bert's share has increased by $100,000. So when he dies, he has this property fair market value of $300,000. ACB is still only $200,000. And as we would expect, there is a deemed disposition here. Now, if he left it to his spouse, then this wouldn't be the case, or a common law partner, but he does not. You'll see in a moment here. So we have a $100,000 capital gain, and that's going to be taxed to Bert's terminal tax return. Now, nothing changed for Alan. Alan didn't have a disposition. His chunk of the property wasn't sold. He didn't dispose of anything. So his ACB is unchanged. His ACB is still $200,000. Now, his fair market value has gone up, but he didn't do anything about it. Nothing happened there. So he's still sitting at his original tax position. Nothing has changed for him. Now, when Bert dies, let's say his daughter, Candace, inherits the property. So now we have daughter C. Daughter C here, Candace. And she inherits the property. and she's going to inherit it with an ACB of $300,000. And that's because Bert started with an ACB of $200,000, and then he had that disposition on his death. That added $100,000 to the ACB. We just take the two tax consequences that we've had already. We don't have any double taxation here. When Bert had a disposition, that increased the ACB of the property in Candace's hands. And that gives us now ACB of $300,000. Okay, and let's fast forward a little bit longer here. Again, no jokes about the real estate market, so maybe more than a couple weeks. And now the fair market value on this property is, let's say, $800,000. And at that point, Alan and Candace decide to sell. Now, technically, Alan could sell his interest without Candace, and Candace could sell her interest without Alan. That would be an extremely difficult thing to do, but technically, that's what joint ownership means. Joint ownership means you can't stop the other joint owner from doing something with the property, but in practice, that's just not going to happen that way. In practice, nobody would buy Alan's interest, knowing that Candace still has her interest in the property. Okay, so at this point, we're going to go through the disposition, and what's going to happen then is Alan, his situation is pretty simple. He's got proceeds of $400,000, half the fair market value. His ACB never changed. His ACB is still $200,000, so he's going to have a capital gain of $200,000. No reason here that the principal residence exemption would apply, although if he did live in it, then sure, maybe principal residence exemption, but let's assume that that's not the case. And for Candace, same thing, her proceeds are going to be $400,000, but her ACB is only $300,000, sorry. And she's going to have a capital gain then of $100,000. And this makes sense. We end up with the same amount of capital gain in both cases. In both cases, we have a total of $200,000 of capital gains. It's exactly what should happen. Or if we take everything and add it all together, if we take all the capital gains that happened all the way along, we've got capital gain of 200,000 here, capital gain of 100,000 here, capital gain of 100,000 up here. Add all of those together, that is $400,000 of capital gains. Well, that makes sense. They bought for $400,000 and they eventually sold for $800,000. And if you do have a question like this on the exam, I don't care if it's specifically a joint ownership question, but anything where you have a tax question, or in real life for that matter, where you have a tax question like this, the thing to do is draw out each step as I have done. I find it's too common where people are presented with the information and they think they should know the taxes right at the bottom. And I don't think that that's the case. And maybe if you've done a ton of tax work over the years, then this becomes more intuitive, but draw it out. And the other thing this does, it reduces the risk of an error. It also increases the chance that you'll pick up on maybe a tax savings measure that could have been applied. There might be something else you hadn't thought about. Go through the steps. This is how we should be doing analysis of complex tax problems. Okay, I hope that's helpful. I hope that you understand how dispositions in a joint ownership scenario work, and I hope your understanding of capital gains is a little bit better as a result of this as well. Thank you very much and enjoy your continued studies.